Today we're talking about all things mortgage, or maybe not all things. Let's get started. Hi, I'm Jeff Abel with the Abel team here in beautiful Estes Park, Colorado. And here on our channel, we like to talk about all things real estate related in the Estes Valley and share what it's like to live in one of the most beautiful places in Colorado. Today, we're continuing our Ask the Expert series, and we have a special guest with us to talk everything mortgage, Harriette Woodard from Bank of Colorado, who is a senior loan officer. Harriette, thanks for joining us today.
It's a pleasure to be here.
One of the things that's probably on a lot of people's mind that they've heard on the news and maybe don't understand fully is the Fed. It's been in the news a lot with interest rate hikes, all of those things happening. Can you talk a little bit about what the Fed is?
Sure. First of all, the Fed did hike the rate 5 times already this year and is expected to do it 2 more times. The November 2nd one almost definitely will be another 75 basis points, and then the December meeting is the one that's a little bit in debate. But the Fed funds rate is just an overnight lending rate for banks, so it's really just a one-day rate. And even though it does have some influence over mortgages, it is not the mortgage rate or a 30-year fixed rate. The way that mortgage rates are driven is mostly by inflation. And what the Fed is trying to do by hiking rates is slow the economy and cool inflation.
So how does that work?
It works 2 ways. The Fed is hiking rates to reduce the amount of credit out there. So what they're trying to do is inflation. The definition of inflation is too much money chasing too few goods. So if you had $100 and a few months ago you could go to the grocery store and buy everything on your list, if you go today, everyone's experiencing this, it buys less goods. So the cost of money is more, or the cost of credit is more. So it slows things down or cools things off because they cost more. And then the other way it works is, it used to be when you were younger, you would go to the bank and you could put money in a savings account and it would actually earn money. And we haven't seen that the last few years. And so it works in that way too. So it encourages people to save rather than spend because the cost of money is higher, the cost of credit. What the Fed rate does affect is credit cards, car loans, home equity lines, those type of consumer loans, not mortgage rates.
So if the Fed rate is going up and we're also seeing mortgage rates go up, it's not a direct correlation one-on-one. It's the result of the effect of inflation is what's driving mortgage rates. The Fed's trying to lower inflation, which should then eventually potentially lower mortgage rates again, correct?
Exactly, but there is some lag time. And so what we've seen is inflation getting really, really high, and that's why we've seen rates fundamentally double over the last year. But this should start cooling it down. And the way that the Fed measures inflation is kind of interesting and has contributed to this. So the way that the Fed measures inflation is the core rate. They strip out energy and food because they really can't affect those things with monetary policy. But what they look at is a year-over-year rate. So we're really looking at 13 months. And if you look at what has happened over the last year, we were at basically an inflation rate of 1, which was very nominal. And so each month we replace that number, and that's what caused so much pain over the summer and the last couple of months, because we were replacing a really low number with a higher number. But coming into October, that's our first higher number. And then we're going to see a string of higher numbers. So really that year-over-year number comes down. So the inflation numbers should start to look a lot better. And so we'll see that first report. November 10th is kind of a magic day. And so if that really comes out in our favor, we should see mortgage rates start to drop. A lot of people are calling for it by the end of the year. It might take a little longer. I think this whole situation looks very much like the 70s and the 80s. And I think it could take 18 months to really sort itself out, because there are, not only Fed rate hikes, there's lots of recession talk and lots of inflation talk, and it's just going to take a bit.
Well, it's that snowball effect of the lag time behind decisions the government makes. one of the factors of the rise of inflation was a lot of the stimulus money they put back into the economy to keep it going. And they put so much that there was more money, which then provided an opportunity to raise prices and all of those things. And so as they take money out of the equation, in essence, it's going to take that same amount of time for this to kind of come back. So the November 10th date you mentioned, if that comes out and it's starting to look better, is that what's going to affect that probably early December decision on the rate hike again?
Potentially. I think they're already talking that, that the Fed is just going too far too fast. And we saw that in the 70s. And then there's this pullback, and then inflation comes back again. And then we go into too deep of a recession, because that's likely what's going to happen is we're headed to a recession.
Right.
And recessions are actually, it's terrible to say because it does hurt people and people will lose their jobs and it's a sad thing. But for housing and mortgage rates, that's, it's actually really good. So we should see housing do really well, and we should see mortgage rates come down considerably, and that history has borne that out. Over the 2009 is what everybody jumps to, but that was an anomaly. Our market looks nothing like 2009, and we can talk about that a little more, but the other 8 recessions since 1960, housing did really well and prices went up, and mortgage rates came down significantly.
So the recession word is something that scares a lot of people, and like you mentioned, it's the Great Recession from 2009 and moving forward was a big impact. It caused by lots of different factors than we're experiencing today. Recession is defined by what?
2 consecutive quarters of negative GDP. And we've seen that, although they haven't called it, which is interesting. And then today they released first look at the new GDP numbers, which actually were pretty favorable. But again, first look, so we would expect to continue to see that. And again, recession is very favorable to mortgage and housing. So in our world, it's not a bad thing. And hopefully it's something that we can recover from pretty quickly and we don't go into too deep of a recession. And there's always on every side of a recession, the other side, the recovery. So, so hopefully everybody.
Well, and that's what we've seen after 2008, 2009, the housing market and the economy took off again. And that's just the natural counterbalance. As far as housing prices is in demand, looking at the national trajectory of median home prices, we dipped so far in 2008, 2009, 2010, 2011 that significant comeback has pretty much put us right on that 4% trajectory of where housing would have been had there not been a recession.
Right. And there's a bunch to unpack there. So first of all, again, 2009, very different. We had a surplus of inventory. People were doing 125% loans. No one had equity in their homes. Looks nothing like the market of today, where we really don't have inventory. New households, we have all the millennials coming out. The birth rates have changed. It just looks very different than 2009. And then if you could go back in time to 2008, 2009 in the Estes Valley and purchase anything,
right.
Don't you wish you could?
Yes.
So even on the very worst day of that, you'd still be way ahead. So, long term, this is always the game to be in. And, I don't see us being affected in the same way. And even the other piece that you said, yeah, we may not see 18, 25% appreciation. 4% creates a lot of wealth. So even if we just come down to some kind of normal appreciation of 4% or 3% or whatever it is, you're still going to make quite a bit of money, and it's still a great investment to buy in the Estes Valley.
Okay, so we've talked a little bit about the Fed, inflation, kind of the tie to mortgage rates and all of that. Not that you have a crystal ball, and not that you're an economist, but if you were looking ahead and kind of trying to figure out where we were moving towards, what would you say?
Well, my money would be on rates coming down. And we talked about inflation and the way the Fed measures it and those year-over-year numbers. I think inflation does cool. I think that the Fed does get control of this. I think the economy slows. And so I think we, would be looking at rates moving back down into the high 4s or 5s. How long that takes is subject to debate. Some people call for that to happen by the end of the year. I think that's aggressive. I think it takes 6 months, a year, maybe even 18 months for it to all sort out. But I think people are very comfortable with rates in the high 4s and the 5s. I think it changes the whole market. We have a whole generation of people that think that rates should be 3 or 2. And they're not going to give up their homes. So that's really slowing the purchase market, because if I have a rate at, the high 2s or 3s, and I really want this other home, but rates are in the 7s, I'm not going to do it. But if the rates are in the high 4s, sure, I'll jump and go out and buy that home. So I do think that. I think that that's where people are comfortable. I think that we see that again. If the Fed wanted to, they could spur another refi boom and put rates into the 1s or low 2s and get everybody refied again. Some people say that might happen. I don't know. I think we'd all be happy to see the high 4s and 5s again.
Well, and honestly, just looking at the economy too, as long as the inflation rate is higher than the mortgage rate, it's still a decent time to borrow, because that $100 that $100 is worth more with a lower mortgage rate than it is with the inflation rate. If you were to go out and hold that $100 and try to buy something in 6 months or 2 years, that $100 is worth significantly less than it is if you spend it now.
That's true. However, also, if this doesn't play out, so just say we don't go into the 4s or 5s, that things can, just continue on this trajectory upward. What happens is affordability starts to change. The thing that they don't talk about is income. Your income will catch up with that. And so maybe we look back and, we thought 7s were so high. That's great. But you'll still be able to afford homes. It just, everything will sort itself out and keep pace. So, even if the other happened, but I do strongly suspect that everything runs better, everything's more comfortable if it comes back down and it does cool and inflation comes down and we get back into the high 4s and 5s.
So given that landscape of where you think things might be going and where we are now, what strategies would you recommend for somebody looking to refi or buy a home?
I would still say buy, and we could talk about that a little after, but with respect to the actual mortgage rate. Normally, if we're in an environment and we think rates are going to come down, somewhere in the horizon, be that 6 months, a year, 18 months, whatever that is, there would be a few strategies you would normally employ. You would look at ARMs, particularly like hybrid ARMs. We saw those a long time ago. And you would look at maybe a fixed rate with no points. But what's happening out here, because short-term rates, we have this inverted yield curve, which everybody keeps hearing about. That means short-term rates are actually higher than long-term rates. So ARMs, really, there just isn't enough difference in them for most ARMs to make sense. And then as far as 30-year fixed with no points, you really can't find that, because investors see this, and I think they also predict rates come down. And investors make their money on mortgages over the interest over the long term. So if they think you're going to pay it off in 6 months, a year, 18 months, they want their money up front. So everything has points to it. And then there's a lot of talk about 2-1 buy downs, 3-2-1, 1-1s. There's all different hybrids of that. It works in certain markets. Just like any mortgage product, there is always somebody that it fits. But in our market, that doesn't really play. That plays really well when you have like a large scale builder who doesn't want their prices to come down, so they're willing to give a lot in concessions, and you can use that money to buy down the rate temporarily. In our market, we just don't see that. There's probably better ways to use concessions if you get them, and that's what I would say. Go buy now. Now's a much more normal market. For a long time, we saw you had to offer way over ask. You had to waive your appraisal, waive your inspection. You had to cover that appraisal gap. There were a lot of things going on that took away any negotiating power. So I think now's a great time to go ahead and buy. We can help walk through some strategy that works, that's not too painful if you have to hang on for a while, and then you just refi. So you've gotten your house at a better price, or at least a reasonable, and then you can refi later. Because if you wait and rates do come down and everything, there's probably going to be a resurgence. And we might find ourselves back in that situation where you're having to offer over ask and you lose your negotiating power, and it becomes, again, a strong seller's market.
So long term, essentially, it's probably better to go ahead and buy the house and deal with the rate later. honestly, if you can afford to do it, because you can always refinance, but that house you want may not be there, or it may cost significantly more. For example, the last 2 years, a $500,000 house cost you potentially, $600,000 the next year. That's a lot of mortgage interest.
Over the long term, real estate is always a great investment, particularly in the Estes Valley. Its history has shown us it's a terrific investment. 2/3 of Americans' wealth comes from real estate. So buy the house now, refi later. We can figure out the money you want to purchase the home.
Well, thanks for taking the time to come by the office today to answer a few questions. I really appreciate it. I think our viewers will appreciate it as well. It's always helpful information, and there's a lot of financial terms that get thrown around that a lot of people don't understand. So hopefully this information was helpful. If they have questions, is there a way they could reach out to you if they're looking to buy a home? What's the best way to get in touch with you?
Absolutely. So my number is really easy, 970-586-1040, and I'm always available.
Awesome. Well, thanks again so much for coming. Thanks for tuning in. We hope this was, again, helpful for you guys as you understand the market that we're in and where we may be moving forward. As always, if you found this video to be helpful, we appreciate it when you hit that like and subscribe button, ring the bell. That way you get a notification when our video comes out next Monday. And be sure to check out these other videos that we think will be helpful as part of our Ask the Expert series. Thanks a lot. Have a great day, and we'll see you next time. Bye-bye.